Have you ever stared at the financial news, maybe a stock ticker, and just felt completely, well, overwhelmed?
Oh, absolutely.
Like some people out there have a secret playbook,
Yeah.
consistently making fortunes while the rest of us are just sort of trying to keep our heads above water.
Yeah,
It can certainly feel that way, can it?
it absolutely can. And that feeling of they know something I don't.
Ugh.
Well, that's exactly what we're diving into today.
Okay.
Our mission in this deep dive is to pull back the curtain on that mystique a bit.
Hmm.
We're going through this comprehensive course called The Art of Investing, Lessons from History's Greatest Traders.
Hmm.
And this isn't just a history lesson. It's more like a practical boot camp. It distills the core principles and, the really personal philosophies that shape these investing legends.
Right.
We're here to extract those powerful, sometimes counterintuitive nuggets of knowledge that can give you a clearer picture and maybe even a potential edge in your own financial journey.
Okay, I like the sound of that. So let's start at the very beginning then. The bedrock for so many investing greats, you mentioned Warren Buffett, starts with Benjamin Graham.
That's the one.
What experiences shaped his thinking, and what was this really revolutionary idea he introduced, the one that guided so many others?
Well, Graham is widely known as the father of value investing. And his philosophy was deeply, deeply forged by personal experience. He lived through the panic of 1907,
Wow.
and even more profoundly, the Great Depression. He saw firsthand how speculation, just going for broke, could decimate wealth.
Yeah, I can imagine.
So these experiences instilled in him this really risk-averse approach,
Yeah,
and that led to his foundational strategy.
the margin of safety.
Margin of safety. Okay, that sounds important.
Yeah,
But what does it actually mean for someone investing their money? Can you break that down?
absolutely. Graham basically defined it as protection against downside risk.
Okay.
Think of it like this. You're buying an investment for significantly less than its intrinsic worth.
Intrinsic worth. So what it's really worth. It's exactly what the business is truly worth based on its assets, its earnings potential, its future prospects. Not just the stock price bouncing around day to day.
Right.
Graham himself said, to have a true investment, there must be present a true margin of safety.
Hmm.
The real genius here wasn't just finding cheap stocks. It was about building a kind of fortress around your capital. It forces you to think like a business owner, not just a speculator, and wait patiently for the markets.
Yeah.
Well, it's irrationality to hand you a genuine gift.
So it's not just about a low price tag, but a price that is like demonstrably a fantastic deal based on the actual value of the company.
Precise.
Kind of like waiting for a really great store to have a massive, undeniable sale on something you genuinely want and know is high quality instead of just paying full price.
That's a great analogy. And what's fascinating here is how Graham illustrated the market's irrational moods. He famously introduced the Mr. Market idea.
Mr. Market.
Yeah, he imagined this schizophrenic business partner who shows up every day, and he offers to either buy your share of the business or sell you his share, often at wildly fluctuating prices, just completely based on his mood.
Huh. Sounds familiar.
Right. So this Mr. Market, in his euphoria, might offer you an absurdly high price, or in his unjustified pessimism, an absurdly low one.
Uh-huh.
The intelligent investor's job, according to Graham, is just to ignore Mr. Market's mood swings and simply take advantage of them. Buy low when he's depressed, maybe sell high when he's giddy.
I think I've definitely been swayed by Mr. Market's mood swings before. Just knowing about this analogy, though, it really helps clarify how crucial it is to stay calm when the headlines are screaming panic, right?
It absolutely does.
Sorry.
It's such a powerful mental model for maintaining emotional discipline.
Okay, so building on Graham's value ideas, this other school of thought started to emerge. You mentioned Buffett described himself as, 85% Graham and 15% Philip Fisher?
That's the quote, yeah.
So if Graham was all about value, what was the gap that Fisher and maybe T. Rowe Price saw? What led them to pioneer this whole different philosophy, growth investing? What did that actually look like?
Right. So while Graham sought safety in undervalued assets, Philip Fisher and T. Rowe Price Jr., they really pioneered growth investing. Their focus was on identifying these rapidly growing smaller firms that have the potential to become the next large firm, like a young Microsoft or Apple.
Ah, okay. Looking for the next big thing.
Pretty much. And Fisher's approach was really about understanding the qualitative side of a business, not just the numbers. He developed what he called the scuttlebutt method.
Scuttlebutt. Sounds like gossip.
Sort of. It was this rigorous fundamental analysis that goes beyond looking at a company's financials.
So not just crunching numbers off a spreadsheet, but really getting into the weeds to understand the company's, well, its DNA, almost like being an investigative reporter.
Exactly. It involved talking to management, sure, but also competitors, suppliers, even former employees, trying to get this comprehensive 360-degree view of a business.
Wow.
Fisher's scuttlebutt was pretty revolutionary because it recognized that a company's real value often lies in its culture, its management's integrity, its R&D.
The intangible stuff.
Exactly. Those qualitative factors that balance sheets alone just can't reveal.
Yeah.
This gave you, the investor doing the work, a potential information advantage.
That's a huge shift in perspective. So what specific things did Fisher look for in these growth companies?
Well, he placed immense emphasis on the integrity of a target company's management. That was huge for him. And also a firm's ability to keep growing when a product has run its course.
Ah, adaptability.
Right. Think of, say, IBM's big shift from mostly hardware to services. That's the kind of thing he looked for. And this led to his famous long-term holding philosophy. If the job has been correctly done when a common stock is purchased, the time to sell is almost never.
Almost never.
He practiced what he preached. Famously held Motorola stock for like 49 years.
Wow. Okay. And T. Rowe Price, similar idea.
Similar focus on growth, but maybe a bit broader. Price focused more on identifying the most promising company or companies in a growth industry, sort of like sailing with the wind at your back, leveraging those big economic trends.
Okay, so it's not just about finding a bargain like Graham, but really identifying a potentially great company with excellent leadership and a bright future, and then just sticking with it, having real conviction.
Precisely. It's about conviction in the company's future potential, much more than just its current assets on the books.
Now, let's switch gears a bit. Let's talk about an approach that really democratized investing, offered this powerful simplicity for pretty much anyone looking to build wealth long term.
Right.
For many of us who aren't watching the market full time, this next idea is genuinely revolutionary. What's this simple, low-cost investment strategy the course talks about? The one that can apparently outperform like 90% of professional fund managers over time?
That would be John Bogle. John Bogle. And his groundbreaking innovation.
Index funds. Index funds. Heard of those?
Right. They're basically mutual funds that track the performance of a specific index, like the S&P 500.
So you just own a tiny piece of everything.
Pretty much.
Yeah.
Their major benefits are very low trading costs, and yes, their consistent ability on average to outperform most active managers over the long haul.
Why is that? Why do they outperform?
Well, Bogle's genius was in recognizing that for most investors, the path to good long-term returns wasn't really about outsmarting the market. It was more about embracing its collective wisdom, keeping costs incredibly low, and just letting the power of compounding do its thing without interference.
It's kind of incredible to think that doing less can actually lead to more. But, for a lot of people, that urge to actively do something with their money is really strong. What's the biggest, maybe psychological hurdle to just embracing Bogle's simple, passive way?
That's a great question. I think the biggest barrier is often just that human desire for excitement, for control, maybe the illusion of being able to pick the winners. It's often explained by the idea of intense competition in efficient markets. You know that old story about the finance professor walking past a $20 bill on the street? He ignores it, believing if it were real, someone would have already picked it up. The idea is the market is generally pretty good, pretty quick at pricing in all available information.
Okay.
So Bogle argued that trying to consistently beat that market, especially after you account for fees and taxes, is just, well, it's a fool's errand for most people.
And Bogle didn't just have the idea, he built a whole company around it, right? Vanguard, one that really put the investor first.
Absolutely. Vanguard, his creation, operates under this unique mutual share company structure.
Meaning
Meaning the funds are actually owned by the investors in those funds themselves, not by outside shareholders or some parent corporation.
Oh, interesting.
Yeah. And this structure returns all of its profits to the mutual fund, which significantly lowers the expense ratios, the fees for investors. Bogle deeply believed in being a fiduciary, managing assets solely in the best interest of the client. It earned him the nickname St. Jack.
St. Jack. Wow. That's quite a philosophy. Okay, so what does this all mean for you listening? Should everyone just pile into index funds and, call it a day? Or is there still a place for trying to be active, trying to pick stocks?
Yeah, this raises a really important question, doesn't it? Because while it's demonstrably tough to beat the market consistently, and Bogle argues index funds make sense for almost all people, It's also true that nearly all the great investors we're talking about in this course, they achieve their wealth and fame through active management, which is by definition predicated on trying to beat the market. So it really highlights these different paths to potential success. And maybe the best path for you depends heavily on your own temperament, how much time you have, and your resources.
Okay, but hold on. The greats we're talking about, like Buffett putting that huge chunk into American Express during a crisis, they often put a massive amount of their money into just a few really big ideas.
They do.
Doesn't that totally fly in the face of the classic advice everyone hears? Don't put all your eggs in one basket. Diversify. For someone listening who isn't managing billions, how do they figure out if they have the time or the stomach or the deep insight needed to run a concentrated portfolio like that? Or if maybe a more diversified, sleep well at night approach is just smarter?
That's a critical point. If we connect this to the bigger picture, yes, most great active investors do tend to own a pretty concentrated portfolio, maybe somewhere between 10 and 30 stocks.
Really? That few?
Often, yeah. Their argument is basically that it's better to have a few eggs in a basket and watch the basket carefully than to own hundreds of stocks because you simply can't follow that many companies in real detail.
Right.
Buffett's famous investment in American Express during the salad oil scandal. Yeah, long story, but basically Amex got caught holding collateral that turned out to be worthless salad oil instead of, well, real assets. Their stock tanked.
Oh, wow.
Buffett swooped in, put 40% of his partnership's assets into it. He saw a temporary problem hitting a fundamentally great company. That perfectly illustrates this concentrated conviction.
Okay, 40%. That's a huge bet. It paid off massively, obviously, but it really underscores the amount of conviction and, deep analysis needed.
Exactly. It's really for those who have the time, the skill, maybe the inclination for truly deep research into individual businesses.
Okay.
However, it's definitely worth noting, as you said, that other great investors follow a much more diversified approach, like Vanguard founder John Bogle, obviously championing index funds.
Right.
And also successful quantitative investors, like James Simons at Renaissance Technologies. They run dozens, maybe hundreds of different investing models, making tons of small bets all the time.
So using algorithms.
Exactly. Using algorithms to find tiny, tiny advantages across a huge number of positions rather than doing deep dives into just a few companies.
Okay.
So for our listener, I'd say unless you're really prepared to dedicate significant time to understanding individual businesses deeply, diversification, often achieved easily through index funds, is generally the more prudent path. It helps manage risk and aims to capture market returns.
That makes sense. It's a stark contrast in strategies, though. Okay, let's move to another really interesting debate. Where you invest. Peter Lynch, another legend, gave us that famous advice. Invest in what you know. Leverage your personal insights from your daily life, your job, whatever. But then you have someone like Sir John Templeton who said, if you search worldwide, you'll find more and better bargains than by studying only one nation.
Right, the global perspective.
So how do these seemingly conflicting ideas actually maybe fit together? How can they offer a practical strategy for our listener?
Yeah, they seem contradictory, but both maxims have real merit. They just reflect different but equally powerful potential edges an investor might have.
Okay.
Lynch's approach, invest in what you know, taps into your potential investor's edge, maybe from your job, your community, your hobbies. If you use a product constantly, or you see a trend emerging in your local town before Wall Street catches on, that's an information advantage, potentially unique to you.
Right, like seeing everyone suddenly buying a certain type of sneaker or something.
Exactly. But Templeton, who was a real pioneer of international investing, proved that one's chances to earn attractive returns increase with broader investment opportunities.
Makes sense. More ponds to fish in.
Precisely.
Yeah.
He actively fought against the home country bias, the tendency for investors to just stick to their own country's market, showing that excellent companies and great bargains exist everywhere. His Templeton Growth Fund famously grew $10,000 into something like $2 million over decades, significantly beating the S&P 500.
Wow, $2 million. Okay. So it's not necessarily an either situation then. You could maybe use your personal insights for specific companies you know really well, but also make sure you have exposure to global markets, maybe through international index funds, to capture those broader opportunities.
That's a great way to think about it, yeah.
Yeah.
For the learner, it's about recognizing your unique advantages, if any. If you have deep insight into, say, the software industry because that's your job, that could be your Lynchian edge for a specific investment.
Okay.
But for broad, diversified growth, ignoring 95% of the world's companies because of home country bias, probably means missing out on potential opportunities. And that's where Templeton's global perspective is so valuable.
Right.
The key maybe is just being intentional about why you're investing in something.
Mm,
Is it based on specific local insight, or is it part of a strategy for global diversification?
got it. Be clear in your reasoning.
Exactly. So if listeners remember just one thing from this whole deep dive into these investing giants, maybe it's this. Successful investing demands a blend of rigorous analysis, emotional discipline, and a strategy that's really tailored to your own temperament and resources.
Analysis, discipline, and knowing yourself.
Pretty much. Whether you choose a Graham-style value hunt or a Fisher-esque growth approach or just simple passive indexing or a global search, understanding why you're making your choices and then actually sticking to your principles is paramount. As Benjamin Graham wisely observed, the investor's chief problem, even his worst enemy, is likely to be himself.
That's powerful.
Yeah. Overcoming our own psychological biases, like chasing hot stocks when everyone else is, or selling low during a panic, or just getting overwhelmed by the noise from Mr. Market. That's often the hardest, but maybe the most crucial part of the whole investment journey.
That's a really profound observation. It taps into such a common human challenge, doesn't it? So how does just understanding this psychological stuff directly help our listener avoid making those same mistakes? How does it help them get that sense of control over their financial future?
Well, just being aware of these biases, knowing they exist, is honestly the huge first step.
Right.
By knowing that panic selling or chasing fads is a common, often losing human tendency, you can start to build systems and strategies to counteract it.
Like what?
Like setting up automated investments so you're not timing the market, or having a really clear written down investment plan you stick to, or maybe just stepping away from the news entirely when the market gets super volatile.
Let's turn off the noise.
Exactly.
Yeah.
It empowers you to act like an intelligent investor, not just an emotional one reacting to the latest headline.
I love that. It's simple, but really profound, actually. It distills the wisdom from all these incredible, sometimes complex stories into something genuinely actionable for you. Thanks for breaking all that down for us today.
My pleasure.
If you're eager to dive deeper into these fascinating lessons from history's greatest traders, we'll have links to the original course and maybe some recommended readings in the description below.
And definitely let us know in the comments, which of these investment philosophies resonates most with you? Are you more of a Graham-style value hunter,
Yeah.
maybe a Fisher-esque growth seeker, or perhaps a Boglehead index champion? We'd genuinely love to hear your thoughts and insights.
Yeah, do let us know. And remember, as the stories of these legends really show, the greatest returns often come not from just following the crowd, but from truly understanding the crowd's behavior, and sometimes having the courage and the discipline to actually go against it.